through all these measures, try to reduce the gap, because if the gap is too high, there's too much of an incentive to make temporary profits. So always I think in Japanese context, it was had a particular name. What is it called? Trait, something trait. Anyway, it doesn't matter. Reduce the gap. Continue acceleration of tariff reduction. So at this time, when you're getting the surge, even the permanent part, because the whole economy will take time to react. So this is an ideal time to take your tariff, import-export trade free. You still got constraints, remove them. A faster opening of the capital account to resident companies. Allow entrepreneurs to go out. For all this money sloshing around, you don't want their appreciation. So let them go out. That's what happened. That's what we did. Okay? So you got this huge increase. Okay. So in the beginning of 2007, we are dealing with this capital flows, and then there's this huge commodity boom starts. Okay, I have just given one graph because I don't. This is the Indian effect. Behind it, there's a whole analysis of what's happening to international commodity prices, and most of them go like this and like that. Okay, you take iron ore, oil, food, all these elements. They're just jumping like this. You can just see from looking at the graph that is going to the roof. You don't have to look at the growth rates. So what happens is, look over here, this 7, 8, this big spike over here. Okay? So basically this is primary fuel, which is your oil-related stuff. This orange thing here, and then there's a huge gap up here, that is your gray. That is the blue mineral. Should be the mineral. Okay, sorry, I think it's mixed up here. This gray actually is the mineral. So basically the commodity price boom goes here. Now again, just try to ignore this here, right? You don't know what's going to happen in the future. You're seeing this huge boom. First thing you again have to decide, is this going to continue for 2 years, 3 years, 4 years? Or is it just 1 year? So what is the permanent, what is the temporary? Because it has completely different implications for monetary policy. The standard Keynesian, the classical view was that if you have a temporary increase in commodity prices, you accommodate. Now this is kind of important to understand the difference between a one-time rise in prices and an increase in inflation. Okay? It's a fundamental difference which again you will never hear in the press. Okay? A one-time increase is not inflation. Okay? Inflation is a continuing phenomenon. What monetary policy is supposed to focus on is the continuing effects. Now that doesn't mean the one time is not important, because it can set in motion expectations that because it has increased, now it will continue to increase. What is sometimes referred to as cost push. Okay? So you actually, the theory says if everybody is rational and everybody is perfect in some sense, you can accommodate that. That means you just expand the money supply by that much to accommodate that one-time rise. But the problem is how to control the expectations. Because then they think, if the zero price rising now, why won't it keep rising? Okay. So these two problems have to be addressed. Okay. So again, we have these differences of opinion because you have to decide. So RBI is generally on one side and I am on the other side. But something is done. But hard decisions are to make. There's no perfect, there's no written thing, there's no formula, there's no computer. Okay? You've got to make a decision. Okay. So actually what happened, just to complete the further story, is it actually collapsed after that. Right? So it was one time. So it just turns out that in some sense I was right. Okay? So you could accommodate more of it rather than squeeze the monetary. But it could have gone a different way. So I don't say, but what I say is you have to think about it. You don't just automatically do whatever some standard computer tells you. Okay, so we are over the commodity boom, somehow we've handled it, right? Now we hit by the global financial crisis. So I love this graph because the story, it's an interesting story. In August 2008, all of us from the finance ministry, the RBI governor, are at the IMF World Bank conference. Every August, there's a conference. The dates keep changing. It hasn't happened this time. But anyway, in those days it was August. So we are sitting there, and then we are on the plane flying, and the financial crisis occurs. So we have no clue, and then we are flying, and there's nobody here. Okay? Of course, RBI governor keeps in touch with this, and all his people are there. But for this kind of a collapse, you need the governor, and you need the finance secretary and everybody else. So look at this. Look at this blue line here. So we are sitting here when we leave India and we go to Washington. This is the reserve money. This blue graph here for 2008. The other green and red are other years. They move smoothly, right? Previous year. And then you have this big collapse. This is the crisis. Okay? This is like a cliff. So what is happening? There is a global financial crisis which is freezing all the financial markets across the globe. That means there's no money left in the system. Everywhere, including India. I mean, this is a real shock. I mean, when I looked at this, I said, God, the economy could sink. I have to do something. Now, obviously, the RBI also looked at it and said, it's kind of, for the monetary side, it's standard. When something like this happens, you've got to do everything to get the money back on. But see here what they could do. Nothing. They could just stabilize it. Okay? And then the next year it's even lower. So not much monetary action possible. They did whatever they could. Okay? Why is this story important? Because the next part of it is the fiscal. Well, let me just tell you, before I come to the fiscal, just tell you the monetary side. Yeah, let me tell you. So what is happening? So we have the money supply collapse, okay? And you're not able to do too much about it. And then you look at the credit. So that's what they are doing. They're trying to make sure that the economy has enough credit. Again, it's the blue line, which is 2008. So it falls, but not precipitously. They are trying desperately to keep this thing from going down here. Okay? So they are announcing all kinds of credit measures, special dispensation, etc. And then they are able to stabilize. Okay? But again, same story here next year. It doesn't stop. Okay? So why is this important? Because the fiscal side. Everybody in the world, including the IMF, all the markets, which we will be speaking to some of the market people after you, they're all saying India has no fiscal space. We have this huge fiscal deficit. Remember the fiscal problem? On one side we said fiscal causes problem, now I'm arguing the opposite. I'm saying this is completely wrong. Okay? This is the graph I had seen. I said we are in a completely different situation. I've never seen this in my life. Okay? You can't be squeamish. There's no question of fiscal space here. Have to expand the fiscal deficit because your demand is going. Your supply is going, demand is going. There's no global demand. The whole financial system has frozen. Your exports are collapsing. Okay? You have to inject demand into the Indian economy. Everybody else is arguing, no, our fiscal deficit is too high, there's no space. So what's the difference? Difference is this is the worst crisis since the Great Depression. Think, man, you can't just take your textbook, say the normal thing, they're right. If it was just a normal time, they were absolutely 100% right. But I'm saying, no, this is not a normal time. And all the economists, I can tell you, all my friends, criticized. They were saying there's no fiscal space, we should do nothing with the fiscal. And in some sense, I don't want to go too deep into it, everybody else was kind of stunned into silence. So actually, even though before this crisis, we were kind of had this understanding that only the finance minister speaks, after this crisis happened, because it's just too complicated for most people, I started going out and speaking to the public, trying to make the markets understand that this is a completely different situation. You can't do that unless you understand, which is why all those graphs, etc. You have to have an understanding of the economy. Okay? Okay, let's move on. So, non-food credit. So, this is the non-food as I showed you. So, what is happening is that the rest of the economy, the food thing is going on. That's another complication I don't want to get into. So, what happens? So, that crisis we deal with, we increase the fiscal deficit through three means, just to mention for your education. One is what we call automatic stabilizers. That is when the economy slows down, your revenues go down. Okay? The revenues go more than proportionately down. So that gives a boost. The fiscal deficit automatically expands, which injects, relative to what it otherwise would have been, more money into the economy. Right? You're taking out less from the people so they have more in their pockets. That's called automatic stabilizer. The second part, the bad part, which is why I was criticized, was that in the 2008 budget, before the financial crisis occurred, there was something called the loan waiver, which a lot of economists have criticized. And what I argued was, though I agree, in fact it was a bad way to inject money, but the positive, the silver lining, is that because you had made those provisions in the budget, that money is now being injected into the economy when you need it. Nobody had thought of it that way. They were just doing a terrible thing. Why was it terrible? One argument made was, well, you're giving money to the poor. It's not the money, it's the way you're doing it. We much rather, instead of doing a farm waiver, hand out money to everybody. Because a farm waiver, loan waiver means that you set up a bad incentive system for the future. People think we don't have to repay loans, so your whole credit system suffers. It's the bad method. But that bad method was already underway. There's nothing we could have done to stop it. But at least the positive was that the money was actually reaching the economy. So in that sense, it was a big silver lining. And the third thing was, in addition to some subsidy measures, etc., for credit, because remember there's a big credit problem here, which we instituted, we also lowered the tax rates, excise and other rates. So you had roughly 1/3 of it was the automatic stabilizer, 1/3 was this expenditure injection, and 1/3 was the tax measure. And what I had argued, and that's where we are going to come to the problem, to the next problem, this issue, was that this has to be temporary. I'm saying, so don't worry about the fiscal space, but that does not mean the fiscal is not important. As soon as you've dealt with the problem, how do you know you've dealt with the problem? If the growth rate is back to 8. Okay? That's a simple measure, because you were growing at 8% before the crisis. Once the economy goes back to 8, please stop all this. Because the fiscal still remains a problem. It's not gone away. We have to use this extraordinary measure now to save us. But that doesn't mean to get complacent and keep spending. You say, oh, it didn't happen, it increased the growth. It's a different situation. Each situation is different. Okay? And has different impact. So what do we have? So 2009, so we dealt with this crisis, and the personal story, I'm about to retire. The last economic survey, what I said was that I cautioned on two things. One is, because the recovery looked like so easy, the whole world has crashed, we managed to go right back up. We also crashed and we are going up here. Okay? So everybody thinks, oh, we are brilliant. Well, no, we did some right things. Now, if you do the wrong things, the problem is the history of growth tells us that growth, the real problem is sustaining growth. In India, every time we went to 8%, people saying we should set a target of 9-10%. More and more and more. And I'll just give you one table subsequently show this is crazy idea if you look at growth history. That's not how growth works. Okay? And I've been arguing this for 10 years, and the plans, when they kept trying to raise the thing, I said the important thing is sustaining growth, not keep on raising it. 8 is high enough, that's our limit actually, 8 to 8.5. So, second, the complacency from recovery. It looked too easy. You forget all the struggles, all the arguments which I've just given you, and say, oh, very easy. Right? So we are something special. No, we are not special. Warnings in the economic survey in June 2009, and then the Euro crisis after that. So at the end of the year, I leave and go to the IMF, and there are all these bad things happening in the world. So warnings about that. Again, you are making this assumption that the world is going to all recover, everything is going to be hunky-dory. No, the crisis is there. There's a Greece crisis, there's something. Every time it blows up, you're going to be affected. financial markets are affected, your capital flows are affected, that sudden stop problem. For that word, again, nothing, no effect. And so on. Then I started becoming more insistent. I gave a talk at PhD and wrote some papers in 2012. So, a series of warnings. And in the same economic survey, I gave 5 boxes of reforms. Now, people asked, what is this? Is some crazy idea of the CEA is put there? Is the government going to do all this? No, they'll never do it. My idea was to provide a menu. I said, here are the problems, here are the solutions. So please try to do some of these. I cannot decide. I'm just putting, I'm leaving. Okay? You decide. So a whole bunch of policy reform measures to sustain growth. The idea was not just to put them there, but you need these to sustain the high growth. The exact step doesn't matter. People said, which one should we do exactly? It does not matter. Again, this comes from history of growth. There's not one specific thing which is the key, normally. Except that, like when you have that unusual situation where the money has collapsed, obviously you've got the money, you've got to get some money supply into the system. Besides these obvious things, it's never one particular thing. Okay? And then fiscal and monetary policy, I already told you, I have to go back. Okay. So, what do you have? So, what people are seeing, this is the perception, growth, plotting it from 92 to 2009, people are seeing this, it's all going up. It all depends on your perspective. It all depends. You change the time period and you see something else. You look at something else. You've got to look at all these things and decide. So everybody is looking at this and saying, we fell, we recovered where are we? 2007. Yeah, this little fall here. We've gone right back up to over 8%. Great. We are special. Okay, and we'll keep going. So let's set a target of 9%, 10%, 12%. These are actually words of academics, business people, media. I'm not just making this up. Okay? So what is wrong with this picture? First, let me tell you the global, and then I'll show you some different pictures. It depends on your perspective. So here is a correlation matrix. It is based on 180 some countries. We take the average growth in decades, for countries and periods, and we do a cross correlation between various decades. So, like just to explain, let's take the last one. This 90s. So let's focus on the point which is here. So the correlation between the average growth of countries in the 1990s and 2000. So the whole decade of 2000 compared to this thing, you do a correlation exercise. The correlation is 0. What is the practical? The simple practical implication of that is that high growth in one decade is absolutely zero guarantee that you'll grow faster in the next decade. That is the history. And the interesting part of that history is this number has been going down. Look at this change here. It used to be 1/3 for a long time. But in 2000 it just collapses to 0. So this was the warning. I had been doing things like this for the last many years because I studied growth. Okay? And my warning was based on this, that don't get complacent. The problem is we know, and there's a whole lot of other literature which shows there are many, many countries which grow fast for a couple of years and then they collapse. There are only like 12 countries or so which have grown faster than 7% per capita. We generally use per capita to measure the competence. Okay. So, here's a graph which is an annual graph you bring from 2009. Remember I showed you 2009? You bring 3 more years into it and you see there's a huge collapse here. This is looking back. Okay? You're looking back from 2011, looks like we are going to keep growing. We're looking back from 2012 and there's a collapse. Okay? Big surprise? No, that's what I'm saying. Been warning about this. You cannot predict when you'll get the collapse, but it's happened in every country except for this 1 dozen. But even they could only maintain for 1 or 2 decades. Okay? That's the challenge. Remains the challenge for the future, by the way. That's one of the things you should keep in mind. So, if we look at, so one is trying to see what what is it that's driving it? Anyway, this is just incidental, more for the next set of people. We'll skip that. So look at the quarterly from 96, because the quarterly data starts. It's actually been showing you for a long time that growth has been declining, depending on the perspective. If you look at the annual rates, it's telling you that it's going on rising. If you look at the quarterly rates, I've taken it to the last one because I'm kind of trying to examine it now, but we just cut these things out from here, and you'll actually see that it's like a trend down. So it's been, since 2009, 2010, one can see this happening. Okay, that the growth is declining every quarter in the trend line. So here's the fiscal deficit. Our old trend for fiscal deficit is again here from 80 to 2012, and again one simple way to see it is look at this bump. This is a big problem here. Okay? Fiscal deficit is a problem. Goods and services deficit, same problem again. The deficit suddenly rises. Okay, sorry, this is negative. Yeah, this is the total goods and services. It becomes negative here. Okay, for 3 years. Current account balance. Rush a bit. So we have a different issue here now. See, the invisible balance is going fine, positive. It's now the trade balance. Okay, this is the contrast I wanted to show you. In the earlier period, the trade balance was improving. Here it is declining. Remember, the same reforms, these are 91 reforms which everybody in the world thinks are no match